All right, everybody, we are live. This is May 10th, 2023. Michelle, Mike, can you guys hear me?
We
Yes.
can.
All
Good
right,
evening.
Hello.
we welcome everybody to the Web 3x3 for May 10th. This is today we're going to be talking about Web 3 and the world of money. Our goal, episode 26, making crypto wallets safer, why blockchains are like trading routes, and how TradFi is battling DeFi, which we'll get into all three of these in depth. And then afterwards, we're going to be doing a little Q&A on Twitter. So with me, as always, my hostess with the mostest, Michelle Peterson-Clark, the content marketing queen.
Hi, everyone. Back in the UK this week.
And, of course, Mike Neubauer, your ops guy.
Away from the cloudy skies of Cleveland into the sunshine of Florida.
And I'm Mark Angelos. All right, so we're going to jump right in here. Topic number one comes to us courtesy of Mike, and I'll just give a quick intro and let Mike walk you through the ins and outs of what this means for you in the business world. For those who are curious, Web 3x3 is a weekly discussion where we discuss how blockchain is transforming business. So the article to kick us off is one-click checkout buttons for Web3. And there's an article here that Mike will walk us through that discusses the way wallets are structured today. It gives root access to smart contracts anytime we sign them with an address. So this basically is prone to phishing attacks, and there are various ways to combat this. But Mike, I'd like you to set the stage, contextualize this, and tell us a bit about what the problem is, and then how this article solves it.
Well, I mean, we've been saying this for, I guess, every episode that the onboarding process has really been a big challenge into entering blockchain technology and, just overall Web3 in general for whatever purpose. The elements of setting up a wallet and then transferring crypto from your bank account and then bridging that crypto to other cryptos. Like, these are major barriers that prevent the transactions from ever occurring, especially in real time. Some of these processes have multiple week, I guess delays to them. So I guess, the guy who wrote this article, John Joel, he maybe is a listener. I don't know. I mean, he's clearly on the same wavelength. He's clearly on the same wavelength that the one button, as we call it, the app that makes waffles, is the solution to some of the onboarding issues that this industry faces. Now, one of the key components that I thought was very interesting is, rather than signing each transaction in your digital wallet, which is what you would typically have to do now if you're going to make a call on chain, which is basically executing a function on the blockchain, you would have to sign the transaction from your digital wallet into whatever contract you're interacting with. Rather than doing that, there's a proposed solution, and some of it's being tested currently, where you almost put, certain amount of funds in some sort of an escrow account. And that escrow account acts as that one button transaction. So the best way I could describe this, and, forgive me, Michelle, if you guys don't have this over there, but, in New York and Florida and in most of the states on the toll roads, you have basically an easy pass or a sun pass. And what you do is you link that to your credit card, and they don't charge your credit card each time you pass through one of those tolls. They charge you a lump sum of like $50. And that $50 basically stays in escrow in an account. And then when it dips to a certain period, then it re-ups that amount just to make sure that you have enough funds when you go through the tolls. So similar concept here, where you would transfer X amount of I guess, crypto into a specified escrow wallet. And every time you wanted to interact with the transaction, whether it's a free transaction or whether it's a paid transaction, you have a basis of funds that are dedicated to implement this one button transaction solution that not only covers the cost of whatever it is you're purchasing from the smart contract, whether it's a token, an NFT, any of that stuff, but it also covers the gas fees. So, there's a lot of work that obviously has to get done into that, because there's no static fee on the transaction fees, as well as obviously you want to make sure that, the one button solution doesn't get hacked. But I think it's a definite step in the right direction on where, the commerce element of blockchain technology is going.
Real fast, we're getting some comments here from our lovely Linda Ray. Thanks for joining us, Linda. That you're getting a little bit of feedback on the mic. I don't know if that's something set up on this end or not. Um, one of the things that I thought was interesting in that article, Mike, that I didn't realize, Amazon owns the one-click trademark for checkout.
That took me by surprise too.
Insane.
Yeah,
Insane.
Apple actually had to license it from them.
That's fantastic. I think also that the concept of making Web3 seamless, let's call it that, or when, as we like to say on the show, people don't realize it's Web3 when they use Web3. I think that this is a step in that direction. There's an acknowledgement that the friction needs to be removed, and this is one way to do it. Little thoughts from you, Michelle.
And I think the other thing too is that we probably should tell people. I will also put a link to the article in the comments in the Twitter Spaces. But is that they had Amazon? So Bezos has a 20-year patent on the one click. So he did that in 1997. So 2027 is when I imagine you're going to see a lot of people do the one click button because he loses the patent on it, doesn't he? So, like get ready for that. Perhaps we should set up.
Years. I think it's up, and that's why we're seeing more information come about.
Right. Yeah.
But to that point, like that's arguably why they became the monster that they were, right? Like that is a massive component that's overlooked. Yes, they sell everything under the sun, but
yeah,
I really think that technological feature is definitely something that could be taken into consideration of why this is so big.
Linda jumps in here with there's a massive lack of trust on so many levels. He likes, Mike, your the escrow wallet idea for transactions between someone who may want to rent an event ticket token.
That's another conversation. And Linda, I encourage you, if you have time, pop in to the Q&A because I'd love to just chat with you briefly on that towards the end here. But I have really good ideas on how to rent tokens like that.
So for those who don't have Mike's brains, I'm going to just put something in the article out here for people to understand. The goal here is to avoid phishing, right? When you're interacting with the wrong smart contract and you don't know it in Web3, you're at risk. And so the article not recommends, but describes two potential solutions for this. One they call verifying paymaster, which allows apps to pay on the user's behalf. The other would be token paymaster, where the user can pay for the transaction in any other asset that they own in that wallet. So it's almost as it's fungible inside the wallet to pay for things.
Yeah.
Either one of those are novel and interesting. Mike, Michelle, what do you think?
I think the other thing too is that, and very similar, we have in Australia, I don't know here because I haven't done it, but in Australia we have the same. You have you have an e-tag on your car, and when you drive through, it takes it, but they take $40 at a time, and like before you know it, another $40 gone, and then $40 gone, and then suddenly when you try and reconcile your account, you go, hang on, we spent like $400 on tolls last month. How is that possible? And so it's like a seamless thing, isn't it? And that's what they're talking about here. They're talking about being able to make it easy for people to, spend money that they don't necessarily know they're spending. And one of the other things that the article talks about is likening it to buying gift cards at the supermarket. Or, like anyone who's bought a PlayStation voucher or a Fortnite voucher or whatever for their kids would know what that's like. You spend 50 or $100 and that's what's on the card, and then they load that into their PlayStation account, and then they can just, willy-nilly buy whatever it is that they want up to that amount. And so PlayStation have got the money already, haven't they? Whether you use it or not. I mean, how many times do you get given gift cards where people have spent the money, but then you actually never cash it in or it expires or whatever? So, I mean, in that point of view, I think it's probably a way that they are going to be able to predict what revenue might be for those businesses as well.
I want to, as the banking mind here, I want to bring something to light that most people don't realize. Anytime there's a pot of money sitting somewhere, if people have put a balance on their kid's lunch card or on your Easy Pass money, or in the case of New York City, the subway cards, like the Tube in London, you can put money on it and it sits on a balance sheet somewhere. that amount of money, which can be, if there's 8 million New Yorkers and half of them have subway cards, I'm going to guess there's millions of dollars, tens of millions. And so that money can be loaned against for loans. That's usable money. The whole concept of currency in the old world was you wanted the money to move. So who manages that money has not come. There's not a problem right now because there's not really a pot of money. But the minute you have something that can become a slush fund, you got to be concerned. And I know this is DeFi we're talking about, so hopefully this would have solved for that. But that is the traditional problem with these types of structures.
Well, not only that, you're talking about an extremely volatile market, right? I mean, in New York City subway system, you can easily the revenue generation is going to be for people who purchase those classes, right? There's actual data for that. The minute you start incorporating crypto or any of these other digital assets in the Web3 or blockchain world, now you're talking about a very volatile, very volatile asset to put a loan against. I don't know how many people are going to be willing to do that.
Right.
The final point that I think I want to make on this, just based on the information there, is that while all this is, in my opinion, a very big leap forward in the onboarding process, right, in generating massive
into the technology, the use cases, whatever you want to call it, right? It could be stamps, it could be blockchain, it could be this DeFi system, however it's labeled. It's a massive step forward, but I think the practical use cases for this type of application are going to be more specific to level 2 chains, not level 1. Meaning Polygon, Arbitrum, Optimism, where the gas fees exist, but they are so minimal that you can easily have a balance of $5 cover all of your transactional costs for the given month. Versus Ethereum, which can bounce between $2 and $50 any given minute.
Mike, I didn't think of that at all. Ahead,
and
Michelle.
that's an interesting point, because today I went to try and buy to move Ethereum to Optimism, and a $20 NFT was going to cost $98. So that was like 4 hours ago, like insane. So obviously, we did a different way of doing it. But I mean, I think the other thing too is that it's important to understand that this is a way in which the business can actually soak up those fees, so it's even less friction for the people. So if it's only going to cost 1 cent or 2 cents per transaction, wouldn't you just go, you know what, we're going to include that in the price? And remember at CEX last week, Jesse Cole talked about reducing friction, didn't he? One of the frictions of baseball tickets was not just the tickets, but it was the transaction fee and the ticket fee and the food when you get there and the car parking and all that. And they've got one ticket that covers everything, all the food, all the drink, your car parking, no transaction fees for your credit card, all of that stuff. And by reducing the friction, like they've got 60,000 people on their waiting list for every game. Yeah. So, from that point of view, that would be an easy way for you to be able to promote and advertise as part of your marketing message, no fees to trade with us, buy with us, that kind of stuff. And I think that that's a positive for everybody.
That's this is definitely in keeping with our theme of how blockchain is transforming business. Mike, good article pick. I'm going to take us to story number 2, courtesy of Michelle, which is a fascinating piece. And as a history buff, I love this one. Ethereum is Venice. The article discusses how 500 years ago, the greatest trading empire was the Republic of Venice, and that the invention of blockchains has created for the first time trading routes of digital goods. And it went on to discuss the consequences of trade, which I'll let Michelle walk us through, and what this could mean. It was a very interesting juxtaposition of history against what we're living through. Michelle, I'll let you lead.
Thank you. So I too am a history. Some of you may know that I have a master's in history from Oxford University. And so looking at these sorts of things is always fascinating for me, where we can transact current with historical events. And I'm part of a writing NFT challenge on Mirror, and came across this article and was smitten with it. I guess and this was the NFT that I was buying this afternoon. So the collection, there was only 10 of these, have sold out now, but you can still read the article online, and I've posted it in the chat for the Spaces chat so people can have a look. But, you know, like it's a fascinating thing. I mean, most people know about Venice and how it was the trading route of Europe when, you know, during the Renaissance. And the article is really talking about, well, is Ethereum the next Renaissance, but in this sort of modern era? And what are some of the consequences of it? You know, trading promotes human progress, and that's what we're seeing with regards to this. Owners of the trading routes get rich. The Venetians were exceptionally wealthy. And, you know, trading is contentious as well. There's always somebody who wants to take your trade away or block your trading routes or whatever. And that's kind of a little bit like what happens with Ethereum by having the, you know, the layer 2 blockchains start to try and take away Ethereum's glory, so to speak. And so I really, really liked this article from that point of view. And it just made me have a little bit of a think about how different it is when you actually look at history and what it is that we are talking about now, and what other lessons can we learn is what I've started to think about as well. You know, like alternative trading routes are forks and new blockchains. And so, you know, that kind of stuff is, you know, are Polygon and Solana, the East Indies company of the Industrial Revolution, for example. So, yeah.
So I don't have a bachelor's from Oxford. I mean, I'm sorry, a master's from Oxford. I'm just a bachelor's guy. But I will tell you this: the historical comparison was fascinating. To bring listeners in on what the article discussed, it discussed the 3 consequences of trade are: 1, it promotes human progress; 2, as you said, Michelle, the owners get rich, the owners of the routes; and 3, that wars are fought over these routes.
Yeah.
And it then went on to connect the dots to denial of service attacks on Bitcoin that didn't specify that. But the U.S. government is clearly in a regulatory mood against the crypto trading routes, if you will. It's a fascinating story of nothing changes, just the form of it. So I really enjoyed it. I thought it was very insightful.
Yeah.
Mike, what are your thoughts?
Go on, Mike. No, go on.
I think it's brilliant as well. And I mean, I'm a history buff, but I'm definitely not an educated history buff. And you know, when I see history somehow repeating itself, it's good. I mean, especially in something positive that made wealth, the primary factor of an entire civilization, right? So I like the way that was phrased. I like the comparison. I hope that Ethereum doesn't become a museum somehow like Venice has. But overall,
sinking some days under the water.
Well, hopefully that won't happen, or at least anytime soon. But then again, it probably will lead to more emerging technologies, right? And that's kind of the way that Venice has become a pioneer in these developments. Where the comparison, I think, really sets in from this perspective is that, the alternate routes that were developed because what was sought and seen in Venice has led to a global expansion on just the mechanism itself.
Yeah.
If you're going to compare it to the blockchain, no pun intended, Ethereum was not necessarily the most prominent blockchain that you can build on. And I think that, we're not going to see static blockchains that you can't build on anymore. And then I think that really paved the way for where a lot of these other ones have developed, like Solana. Obviously Polygon developed off of Ethereum, some of these major ones. And, what they're starting to realize is that there's errors and there's fallacies in some of these links and some of these chains. And they're just developing new ones that can make it better.
Hang on, Mike. I'm gonna push back. I'd like to remind the listeners that it's feature versus bug here. The purpose of the blockchain that Bitcoin was built on, the Bitcoin blockchain, was to not be built on.
Yeah.
Again, again, the value of Bitcoin is much higher than Ethereum, but the use case of Ethereum is much more vast than Bitcoin.
Right. But the intent of
Yeah.
it was only to overthrow the fiat. It was not meant to be the universal everything app.
It was an alternative banking, wasn't it?
But that's an alternative that led to something better, right? Because it could still disrupt the fiat system. You could still take Ether as currency, just like you could take Bitcoin. But
yes, but you can print
build on.
you can print Ether theoretically. I mean, I'm just playing devil's advocate here. You cannot make more than 21 million Bitcoins. Can't.
Okay, so there's a cap on it. I understand that component of it. It doesn't change the average individual or the average small business from accepting it as a medium of exchange.
Yeah, as ordinals are proving. You're right. Absolutely. No argument.
Bitcoin pizza.
All right. So the third story.
So can I make just one more comment before we go on to that? So, the second to last line of the article says, history shows us the power of the Renaissance will depend on the neutrality, the cost effectiveness and security of the trading routes. Now, that thing, I think, links to the first story that we were talking about. At the moment, security is one of the biggest setbacks this space has, and how to solve it and how it's going to go forward. And I think that that's one of the things. If we overcome that, then we start to tick a few more boxes.
I'm going to go more nefarious than that, Michelle. In the case of crypto in general, challenging these institutions like governments, I think that you're going to have there really is going to be it's not a phishing thing that you got to worry about. It's organized takedowns of these blockchains because they represent a threat.
Yeah.
That's my tinfoil. All right. So I also, to close out that story, I would be lying if I didn't say that I thought of Star Wars and the trade routes with the Hutts versus the Pikes. So I thought that it's very predictable in that wars come on the back of trading of goods. It's just, so I don't know, economically is what would happen here.
But then there's the whole pirates coming, being a new way to make money as well. So there's all that.
Story number 3 is blockchain partnership announced by Microsoft, Goldman Sachs, and others. So there's a new partnership, the Canton Network. It'll be Microsoft, Goldman, the Chicago Board Options Exchange, Deloitte, and a bunch of other companies, big firms, institutional firms, mostly out of the U.S. They are going to be creating a closed blockchain to connect financial institutions. They're going to build, these are apps that will be built on DAML, which I'm not familiar with, but Mike, maybe it's a smart contract language devised by a company named Digital Asset, which is run by a key former JP Morgan executive. So essentially, my take on this is this is the beginnings of Wall Street trying to take over the trading that they've lost to DeFi. And the first thing they need is a blockchain that they control. So we'll come back to that in a second, but I'd like to get your thoughts on this. What were your guys' feedback? We've not heard each other's feedback before these stories, folks.
Mike, we'll you can start.
Mike, we'll hit you first.
So I love the use case of the technology, and it's brought to a scale that has a tremendous amount of money and incentive behind it. Regardless on whether it's public or not is irrelevant. They're using it for the purpose of why it needs to be used. And that's A, for transparency, B, for consistency, right? You're talking about a consistent ledger that these 3 companies can actually utilize, rather than each one having their own softwares or filing cabinets. Everybody's going to know where to look for certain transactions. Now, due to the misconception, all blockchains don't need to be made public. Right? Companies can build private blockchains, which replaces their internal serving farm or replaces their reliance on something like Amazon Web Services as, whoever's hosting their server network. So the blockchain technology component of this is really what intrigued me the most, because they're utilizing the technology not to sell apes and things like that, but to actually use it for its intended purpose, which is a decentralized ledger, a digital ledger of sequential transactions that can easily become audited. I
concerned about closed blockchains. I feel like the open nature of Web3, this violates that. The minute you have a closed system, you're talking about control. Now you're right, it is still transparent theoretically if I can go back through all the transactions I see, but I feel like it doesn't. And I do fully expect it ends up here. I've said this from the beginning. In the end, Wall Street controls these. I hate that, but I think that's going to be true. But
so I like
it for one reason in particular, because although most businesses who are not public don't need to show their books, don't need to show the transactions unless it's to investors or the SEC or the IRS if it's audited. Having a closed loop blockchain is important because it protects that privacy. Now, if it's a public company and those transactions, rather than being reported quarterly in a mandated quarterly report or annual report, depending on the size of the company, now they're visible on chain by anyone at any time. And I think that is really the use case of where this is beyond. I need to be transparent and I need to show everything I'm doing so that nobody calls BS on my action.
yeah,
And I think this, if you think about it from a large company perspective, forget about the financial world, which is clearly what this is about. But you move into the Walmarts and the Targets and some of the major box stores, and then trickle that down into medium box stores and sporting goods, for example, and then you trickle that down to small business ventures, and then those small business ventures have blockchains that are specific to industry, which has suppliers linked to that same blockchain. All of this should be closed loop blockchain. But it definitely improves the operational efficiency behind the scenes using the technology.
right.
Yeah,
So,
and Linda said in the comments on LinkedIn that, it's closed because it means that they don't have to share their data. But ultimately, what does that mean? It's kind of a little bit like Facebook. That they sell your, lists, and if email companies, we've signed up one time for a particular email list, and now we're on 50 email lists with this. This is the only company we ever signed up for with this particular email address, and now we just get constant emails because clearly the list has been shared and reshared and shared and sold and whatever. Maybe ultimately that's what they will be able to do with this, which maybe then we'll have to see some other, opt-out or opt-in situation with regards to that. The thing that I think is really important about this is that we're seeing some big players collaborate to move the space forward. And that's not something we've seen very much until now. Now, we've seen bigger players like we've talked about Starbucks, Odyssey program and those sorts of things. So we've had some big brands come into the space, but this is probably one of the biggest collaborations that we've seen.
so
I want to throw a question out to both of you guys. Like, do you feel that collaboration between those massive entities is a way to mitigate risk, or is it a way to actually try to figure out the best use case to use the technology in Korea?
you're honestly asking what I think of why they're building it? Is that that sounds like what you're asking?
I just feel like
why are they doing it collaboratively rather than individually? To mitigate the risk, or is there some sort of collaboration measure that they feel like?
No. So quick background on this. This might, I'm agreeing with Michelle. This might answer your question. This is history now. In 1992, on Wall Street, there was the growth of electronic trading was beginning, and every company built their own interface with the internet. So depending on the broker or the money management firm, it was a very different structure. They couldn't talk to each other, which creates problems. So the industry sat down and came up with the Financial Information Exchange Protocol. FIX is still used today. It is the established protocols that if you build anything for trading, it has to fit these parameters. And with that, all the companies can talk to each other now. Great. So I think that they're trying to set something like that up for a framework for risk. I agree with you, Michelle. However, Mike, it does enable control.
Control on what? This is a closed loop system, and their intention is to open this blockchain up for the masses. Like, if this is going to be trading protocol on Wall Street, and that's a different discussion. If this is an internal chain that they can utilize for whatever business ventures they're associated with collectively, and that includes their investors, and those investors there have access to that closed loop system. Again, we have to take the blockchain down to its fundamental roots. It's nothing more than a sequential list of transactions.
So
digitally stored on this chain.
I'm a little bit conspiracy here, so bear with me, but this is my thought. You've got the makeup of this group that's building this is one of arguably the premier technology company in the world right now, Microsoft. You've got the premier broker-dealer, Goldman Sachs, and Deloitte is that advises money managers and big firms on what to do. So this is like the perfect witch's brew of if we were going to put together something that everyone should use, that's what they could put together to figure it out. So I think that once Coke and Pepsi are using the thing, then 7-Up is going to want to use it too.
Yeah. And I think that it's what can we do with that? How can we advance it? And, it's like I said, I've said it a few times, the suck it and see thing. They're doing it together so that the risk is less. I think too that, we've seen, haven't we, that getting competent tech people in this space isn't easy.
No.
And so by doing it together, it means that the team they put together can be smaller rather than 3 entities. They can have a team that collaborates and, is a collective. And then they can, with the money that they yield, they can just get the best people, can't they? Because they can pay them a lot. They could have their prompt engineers on $300,000 US a year.
Right. I think that whole prompt engineering thing, while it's hot now, goes away eventually.
Sure, of course. I'm being cynical. Now, I've got one other thing that I'm going to throw in before we go. If we're about to wrap up,
I was going to just give you a little disclaimer, but go ahead.
Oh yeah, just before we do the disclaimer, I read something just before we came on air, and I didn't even have time to drop it by the guys.
Breaking news.
Yes, breaking news. So people will remember that over a couple of podcast episodes recently, 3 or 4 months ago, we talked about Amazon and their NFT marketplace. And I believe that we mentioned on those podcast episodes about how surely they will come out with their own blockchain when they do it. So I read an article in Crypto Slate today, and even though nothing has been confirmed by Amazon, he has said that Amazon will launch their own private blockchain. It's going to be called Amazon Digital Marketplace, because we also talked about whether or not they will say NFT, because we know everyone is sort of shying away and moving away from it. Now, whether that's true or not, the 15th, and it's the 10th at the moment, so we've got 5 odd days to go, is rumoured to be the date that the marketplace will launch. So let's just see if what we called 3 or 4 months ago actually happens next week or when it's launched. But this particular article is confirming the things that people would have heard first from their Web3x3 co-hosts.
The long-time listeners of Web3x3 would remember that we discussed how Amazon, if anything, is a platform, right? It's a marketplace, and that is what Web3 essentially is. You've got a way to interact, interchange, trade goods, create support for. It's both a marketing and an operational piece. Amazon, I think, is the most to gain. Amazon, maybe Disney.
So let's tie it all together with the first article that you referenced. This one-button solution with Amazon being forefront of that, holding the patent for 20 years, licensed patent, becoming a monster that they are. My only tinfoil hat comment here is like referencing this as a digital marketplace as opposed to what? The physical marketplace, which is Amazon. Give me a break.
Venice.
Yeah.
Right.
Yeah.
As a reminder to
but it's
listeners,
an interesting thing, though, isn't it?
Nothing here is meant as investment advice. This is do your own research. We are just discussing as a business sense how blockchain is transforming business, but this is not intended as anything other than 3 people talking. So don't take this as financial advice. I'd love to wrap this up with
just one more comment on that Amazon piece, if I can. And this was discussed in that former episode, and I think it's worth mentioning again. The practical use cases as a reward for utilizing whatever token they implement on chain, whether it's an NFT or a fungible token, that will have direct sale implications on products that are sellable in their non-digital marketplace. And I think there's going to be a crossover and a bridge that brings everything together. There's going to be specific brands that have specific tokens that are launched on that blockchain. If it's definitely going to be a chain that you can build on, brands will have the ability to build on chain as well, similar to the way that they can build on Ethereum.
Interesting. All right. Well, I'm going to wrap us up. We're going to stick around a little bit on Twitter Spaces for some Q&A. We would love to have you guys.
So come on and have a chat if you'd like to talk to us. We'll stay on for as long as there's questions or comments. But so those of you that are watching on either YouTube or LinkedIn Live, pop over to Twitter Spaces so you can keep the conversation going with us.
Just to set the tone for the room, we've seen how big businesses stuck their toe in, if you will, the retail folks, the gaming companies. We had some Nike activity, guys like Budweiser and Dunkin' Donuts. We're now for the first time seeing institutional money type firms. You're talking about Goldman Sachs and Deloitte and companies that normally they would be finance, banking, and trading firms are now starting to figure out how do we get into this thing. So
Yeah.
it's an evolution.
Yes,
And that's all I have to share
absolutely.
for this week.
Okay, we'll talk on Twitter.
Thank you, Michelle. Thank you, Mike. We're going to sign off of YouTube and of LinkedIn. Feel
See you
free
next
to
week.
follow us, Web3x3 on LinkedIn every week. We'll be back next week, 4 o'clock Eastern time. Right now, we're heading over to Twitter. Cheers.